By the time a retail index fund, a trending stock, or a highly publicized IPO becomes available for you to click buy on your phone, the real wealth has already been extracted, calculated, and legally locked away behind ironclad gates. The ultra-wealthy do not play the same financial game as you do. They don't even use the same rulebook. While the middle class is trapped in a linear loop of working, paying compounding taxes, and begging a volatile market for an 8% return, the economic elite operate within a forbidden parallel financial infrastructure. A network of invisible, hyper-profitable assets protected by complex legal codes and net worth requirements explicitly designed by governments to keep the general public out. Today, we are piercing the veil. We are exposing the 5 secret investments that billionaires actively hide from the public eye. Structures so exclusive that regular citizens are legally barred from accessing them. And number 1 will completely break your understanding of how money works. To the average citizen, a passport represents their identity, their home, or their nationality. To a billionaire, a passport is nothing more than a negotiable, high-yield financial instrument. Have you ever wondered why half of the prime multi-million-dollar real estate in London sits completely dark and empty at night? It is because the global elite treats citizenship as an investment decision. A passport determines whether a government confiscates 53% of your hard-earned income, or if you keep 96% of it. When the United Kingdom altered its historical non-domiciled tax regime last year, the ultra-wealthy didn't stay to lobby or complain. They quietly packed their assets and migrated to Milan, Montenegro, Dubai, or Malta, jurisdictions offering absolute tax certainty and wealth-friendly residency laws. In the United States, the elite execute a hyper-exclusive play called Act 60. By legally relocating themselves and their corporate entities to Puerto Rico for exactly 183 days a year, their federal capital gains tax on new investments drops from 23.8% directly to absolute zero. A tech founder executing a $20 million company exit pays $4.7 million to the IRS if their office is in San Francisco. If they cross the ocean to San Juan, they pay zero. The country printed on your passport is entirely negotiable if you have the millions required to buy your way into the game. To the retail public, a $10 million Picasso or Monet is a priceless piece of human history to be displayed in a museum. To a billionaire, it is a hyperliquid, zero-tax wealth vault. When an ultra-high net worth individual acquires a major piece of fine art at a public auction house like Sotheby's or Christie's, that artwork almost never enters their home. Instead, it is packed into a specialized crate and shipped directly to a fortress known as a Freeport. These are highly secure, climate-controlled, private warehouses situated inside extraterritorial tax-free zones, the most famous operating in Geneva, Singapore, and Luxembourg. Because the artwork technically never crosses a nation's customs border, zero sales tax is charged, zero import duty is applied, and zero capital gains tax is triggered while it sits in the dark, appreciating in value for decades. But the real financial magic occurs next. The billionaire walks into a specialized luxury lender, using that hidden Picasso as collateral to unlock a low-interest line of credit, up to 50% of the artwork's value at interest rates that would make a mortgage banker weep. They take that tax-free borrowed cash and invest it directly into high-yield commercial real estate or private equity. The art never moves, no taxes are ever paid, yet millions in fresh liquidity are unlocked. The public sees the retail show on the museum walls. The elite run the real deals inside the Geneva Freeports. This is an asset class that institutional gatekeepers desperately try to keep hidden from public ears because its returns are completely decoupled from reality. It is called litigation finance. In 2012, a high-profile celebrity filed an invasion of privacy lawsuit against a massive media company, eventually winning a crushing $140 million judgment that bankrupted the publication forever. What the public didn't know was that the plaintiff didn't pay a single dime of his own legal fees. The entire trial was secretly funded by a tech billionaire who held a private grudge against that media outlet. The billionaire turned a personal vendetta into a blueprint for a highly secretive $20 billion investment industry. The mechanism is calculated. A plaintiff has an airtight legal case against a massive corporation, but lacks the millions required to fight a multi-year war against a deep-pocketed legal team. A highly exclusive litigation finance fund steps in. They review the empirical data, determine the probability of a win, and write a multi-million-dollar check to cover all legal costs. If the case is lost, the fund loses its money. But if the case wins, the fund routinely claims 30 to 50% of the massive payout. Burford Capital, the institutional giant of this space, reports winning nearly 90% of the cases they fund, doubling their money on average. These financial returns have zero correlation with the stock market, zero correlation with federal interest rates, and zero correlation with global inflation. It depends entirely on legal merit, a pure hidden cash compounding engine completely inaccessible to the retail investor. You have been told a comforting bedtime story by mainstream financial media that Warren Buffett achieved a net worth of over $100 billion simply by being an exceptionally patient old man who picked great stocks. That is a myth designed for retail consumption. The cold truth is that Buffett mastered the ultimate financial pipeline, insurance float, and the world's richest families copied his blueprint by establishing what are known as captive insurance companies. The ultra-wealthy do not buy insurance from standard corporations. They create their own. A captive insurance company is a private insurance entity typically domiciled in Bermuda or the Cayman Islands, whose sole client is the billionaire's other existing businesses, their real estate holdings, their manufacturing empires, and their e-commerce conglomerates pay millions in insurance premiums directly to their own captive company. Instantly, three things happen at once. First, the premiums paid by the operating businesses are fully tax-deductible, slashing their taxable income. Second, the premiums received by the captive are not taxed as ordinary income. Third, that massive pool of capital sits inside a tax-deferred wrapper, legally insulated for years. While that money sits there waiting for potential claims, the owner is legally permitted to invest it into private equity, real estate, or high-yield assets. This pool of unpaid premiums is what finance calls the float. Berkshire Hathaway's float is currently over $170 billion. Buffett didn't build an empire using his own money. He built it by owning the pipes that collected everyone else's tax-deferred cash. This final concept completely breaks the brain of the traditional retail investor. The elite do not measure real estate or business returns in percentages. They measure success by a single metric: how much of their own capital remains trapped inside an asset, and their ultimate goal is always zero. This is the infinite return machine. An elite investor acquires a distressed commercial property or multifamily complex for $2 million, putting down $400,000 of their own cash. Over the next 24 months, they systematically renovate the infrastructure, optimize the operations, and aggressively raise the monthly rent. The asset is now valued at $3 million based on its newly engineered income stream. Now, the amateur investor would make the critical mistake of selling the property to realize a $1 million profit, immediately triggering a massive capital gains tax bill. The billionaire does the exact opposite. They walk back into the bank and execute a cash-out refinance. The bank issues a new loan covering 75% of the updated $3 million valuation, which amounts to $2.25 million in liquid cash. The investor uses $1.6 million to instantly wipe out the original debt, pulls the remaining $650,000 out in pure cash, and walks away. Here is the secret that keeps the poor poor. The IRS does not tax borrowed money. Because a loan is legally categorized as a liability and not income, that $650,000 is entirely tax-free. The investor still owns the building. The tenants continue to pay down the new mortgage every single month while generating a surplus cash flow. But the investor now has exactly $0 of their own original capital left inside the asset. They pulled their initial $400,000 out, plus an extra $250,000 in tax-free profit. Because they have zero capital invested, their ongoing financial return from this property is mathematically infinite. They have manufactured wealth out of thin air. The global financial system is not broken. It is working exactly as intended, fulfilling the precise design parameters of the elite who engineered it. The system was never built to help you climb the ladder. It was built to protect the assets of those who already own it. The only question that remains is simple. Will you continue to spend your life playing by the public retail rules designed to keep you stagnant, or will you master the invisible architecture of the ultra-wealthy? If you are ready to stop watching the retail show and finally unlock the raw, unadulterated mechanics of high-level wealth, subscribe to Primal Capital right now. Leave a comment below stating which of these 5 hidden assets shocked your understanding of money the most. We will see you in the next documentary.